get some perspective on the markets now. Jeffrey Small is with us, President Arbor Financial. As the markets are selling off and rates have been creeping back higher, and I guess there's less worries about banking sector at this moment, what do you think is going on? How do you interpret it?
Let me consult the crystal ball. There's a lot of questions there, but there was a lot of mystery in the market here when Silicon Valley Bank imploded, and so that seems to be waning a little bit with the Fed backing up everything. But, you know, Nicole, it's great to be here. I was watching Jeffrey Gundlach yesterday, the bond king, and he kind of had a very strange reaction when somebody asked him the same question. He said, well, I have to go back to Rocky and Sylvester Stallone and Mr. T's prediction of pain in the economy. And that's what we see coming down the line. So what we have to do going forward is prepare ourselves to own the best of the best with companies that have good cash flow and the ability to grow in a non-growing, non-credit expanding economy, because that's what we're going to go through. And it's going to be a little bit of time before we get through that cycle and the Fed comes to rescue.
I think there's a lot of worries, too, about earnings going forward. And people want to buy into stocks and feel like everything is getting better. But at the same time, I think they are worried about a recession or even the Fed at some point cutting rates. But really, why would they do that? They'd be doing that because there'd be somewhat of a concern, right? And also about earnings.
Well, there's a couple of concerns there. One, if the banking problem becomes, let's say, minutely systemic, there'll be an emergency rate cut. But if they don't get a hold of inflation and there's no problem further in the banking industry, then they will obviously probably raise rates one or two more times and then be done. But by the Fed's own admission, they said every quarter remaining for 2023 will be a negative quarter-over-quarter experience. Hence, the recession is here. I have more of a tendency to think that the pain from the recession is going to be a little bit more than moderate to mild. And I think we're going to see that happen very quickly in the numbers as we get into the third quarter of this year.
Wait, can you explain that? You think it's going to be more moderate than mild, so it's going to be worse than expected. Is that what you're saying?
I think it's going to be worse than moderate and worse than mild and worse than expected. It always is. You can't raise the discount rate or interest rates 5% in 11 months and expect an economic result in within 18 to 12 months at the minimum. And we really didn't raise rates hard until the fall of last year. With a quarter basis point move in March of 22,
right,
we haven't seen rates really have their chance to dig into the economy and work its way through. That will happen beginning in the third and the fourth quarter of this year. We will start to see productivity fall off. We'll start to see excessive layoffs. And for some strange reason, Nicole, the Fed wants to see people lose their job, right? Their second directive. They want to see 1 million to 2 million jobs lost. And so I think they're trying to hurry this up. Probably because they don't want to pay politics next year in an election year. It could be the first year in election year history where the markets actually don't grow if the Fed keeps up their horrible mismanagement of monetary policy.
So when you're picking stocks now, are you keeping the same strategy or are you changing the strategy?
Well, we buy stocks speculatively, and we only have to be right 60% of the time to be pretty successful. And so that gives us a pretty large margin of error. But as far as this environment goes, what should investors buy? What should advisors buy? What should firms buy for their clients? They should buy the best of breed. Companies are going to have great value potential in an undynamic economy. And so the Fed ultimately will come to the rescue, as it always has. The market is hoping for that. I'd be in shock if they didn't. But what we look for are things like companies that have great free cash flow, that are the best in their class, have better comps than the other companies in their class, that will definitely develop earnings potential going upwards, even though we're probably in our earnings recession presently.
Mm-hmm. And we've seen people moving to some of these big cap tech names, like the FANG names, as they've had the worries about the banking situation. And you like this group, right? Your number one pick is Meta.
Well, I've liked it all year. And as I've said a couple of different times from December forward, in your presence on this network, that, it would be a mistake not to own those as a staple going forward, because one, they were oversold. Meta's up 70% year to date. Apple and Microsoft are up 15 and 20% year to date. They're still trading at a metric that's a little bit below the actual market metric. And so even though we are priced to their maximum range as far as growth right now, we'll probably see a pullback here in the next month, and then maybe a rally going into the summer. Based on next quarterly report, if earnings are strong, these companies will keep moving forward. The price will keep moving forward. And so that remains to be seen. Obviously, But I think out of the potential of all these stocks, if the economy's flatlining, if GDP is contracting, what companies are going to go up? We have to look at the Apples. We have to look at earnings. We have to look at Microsoft. We have to look at Meta. We have to look at Google and Alphabet. Those are the ones that will continue to rise in this kind of an economic environment, and they will become the new value play because they are still selling below their peaks, albeit Apple not included in that statement.
And would you hold these for the long term generally? Is it a short term and a long term pick for these names?
I don't think, I think it's a short term and a long term pick. The longer the better.
I see. Jeffrey Small, great to see you. Thank you so much. President, Arbor Financial. Thanks, Jeffrey.
Thank you, Nicole.